What's up? Welcome back. Good to be with you again today. So the glasses, um, just got back from the eye doctor. Everything is happy and healthy up there in the retinas, and yeah. So I had these on. They dilated them, and so if I take them off, like it's just like get blasted by the light. So I know I look shady today. Today's a shady day, and perhaps that's appropriate because we are not giving advice. We don't give advice on the channel. You got to pay for that. But if I give my perspective on this, then I might look a little bit shady as a CPA telling you that retirement accounts might be a bad idea, right? Because conventionally CPAs, they know all about this stuff. SEPs, 401ks, they're telling you can get deductions if you contribute to these things. And, a lot of CPAs and accountants, what they want to do is they want to give you as many deductions up front and have you worry about the back end of that later. But for me, I try to give like a holistic perspective so that people can kind of, get the most value out of certain things that they do, right? And it's the same thing for depreciation, just as an example. It's like you do depreciation up front, you sell an asset that's been depreciated, you got to do depreciation recapture, which almost nobody thinks about. But you're taxed on the depreciation recapture, and depending on your tax rates in certain years and like different things, like that might not be a good idea to take bonus depreciation now, as one example. But the thing is, retirement accounts are kind of similar. You get a deduction up front for contributing to them, or you just contribute pre-tax, and then um, the idea is, well, we'll pay the tax later. When I retire, and because I'll be in a lower tax bracket because I won't be working, great. I'll get the long-term benefit, and by the way, my earnings will grow tax-free, presumably, as long as I wait until 59 and a half to take out the money and enjoy retirement at that point. But see, that might make sense if you're in your 40s or 50s and you can make it to age 59 and a half before something bad happens, right? If you are 30 or younger, does it really make sense to put your money into a retirement account? Like, there are a lot of factors to actually consider with this, and those are kind of the factors I want to go through today. Because for me, as a 29-year-old CPA with my own business, I don't have a retirement account. I don't deal with those. I'm too paranoid. I'd rather have private, well, hypothetically, I'd rather have private cryptos and, if I can, foreign real estate and, privately vaulted gold somewhere in Singapore. I'd much rather do that than deal with having custodied assets at BlackRock that, if I take out any time over the next 30 years, I'm going to pay a 10% penalty on and then be taxed on all that money that I put in. Okay. It just doesn't seem wise to me. It seems like there are better things to do with the money. And this is just my personal perspective. We don't give advice on the channel. But, I was reading the Nomad Capitalist book by Andrew Henderson. If you haven't checked that out, I would check it out. And he has a chapter in there on retirement accounts. And it was pretty eye opening to me because he straight up just does not advise people to put their money into retirement accounts. And the reason for that is you have had something like a dozen countries over the last 15 or so years who have conscripted funds out of private pensions and retirement accounts to plug government debt gaps and deficit gaps. And this especially happened during the Eurozone crisis in the early 2010s. You had Hungary, Poland, Ireland, France, all of these countries that dipped their toe into taking money from private citizens out of their retirement accounts. And if you recall in the United States back in the 30s, and I know Michael Saylor was just in the news for talking about this lately. I don't talk about Michael Saylor anymore. I just can't even bother. But with this particular story, it's relevant because what happened in the 30s was a gold confiscation initiative. But Saylor was saying, well, it was voluntary. The citizens were turning their gold into the government. They wanted to be good citizens. That's effectively what just happened. If that is actually what happened, why would they need an executive order? It doesn't make any sense. He doesn't understand it. But what happened then was if you didn't pay, you paid fines if you didn't turn in your gold to the government, and then they went into the banks, took out the safety deposit boxes, and took people's gold who had gold. Now they replaced them with like dollars. Um, but the problem was they revalued gold upwards after they had took or taken a sufficient amount of gold. So it was effectively a nationalization and confiscation of the nation's gold. And that can happen with retirement accounts because that's what these foreign countries did. Argentina was another example, but you're not even talking about, sketchy African or, Latin American countries in most cases. You're talking about European countries that did these things to take private pension money and plug government gaps. And so if you look at the United States, the fact that we have almost $36 trillion in debt, you've got another 100 trillion unfunded liabilities, um, does it really make sense to prospect that your funds are going to be okay in a 401k or retirement account the next 30 years with government debt just skyrocketing, going nuclear? And by the way, Social Security is going to come under tremendous pressure over the next 10 years or so. I mean, they're saying the money's going to run out by 2034, and that is less than 10 years away. Um, and that's assuming there isn't another like COVID crisis, okay, where they've got to print like trillions of more dollars or whatever. Um, Social Security is going to probably be means tested, in my opinion. So if you already have a retirement account or if you have a sufficient amount of money, they're not going to let you take your Social Security. They're going to, um, if they do allow you some Social Security, allow you to take a less amount of what you would have otherwise been entitled to. They're probably going to do that kind of thing, but they're going to have to afford giving Social Security out to the people who need it. And so you have to wonder, okay, where are they going to get the money? Where are they going to get the money for all this? And, I was doing research the other day, and I found a government research report on how much money was in United States retirement accounts. You've got $40 trillion sitting there in these retirement accounts. 40 trillion. And the government debt is $36 trillion, like I said. And what's interesting, if you look at the last 20 years, those things tend to kind of match each other. The amount of the retirement accounts and the amount of government debt. There seems to be some kind of like correlation between the two. And of course there is, right? Because it's financial assets which are being inflated by the monetization of the debt. And a lot of those financial assets are in, retirement accounts. But um, in my opinion, they're going to come after the retirement accounts. I mean, that's how they're going to try to fix this problem. Um, and if you have your money in these retirement accounts, okay, they can probably take them, or they can change the rules. They could change it to where your retirement age isn't 59 and a half, instead it's 65. They've done that in different parts of Europe already. They've done that in China recently. They could say the early withdrawal penalty isn't 10%, now it's 20%. You can't take your money out. They could say, well, you need to have a certain weighting of U.S. Treasuries in order to keep the debt monetized and to keep people buying the debt. You have to have a certain weight of U.S. Treasuries in your retirement account portfolio. They can mandate that, and that would be kind of like a slow motion nationalization of the retirement accounts, because effectively, people would buy less stock and people would buy less assets, presumably, with their funds and buy more U.S. government debt. And they could change the rating over time, the weighting over time, and they could otherwise just conscript the assets or nationalize these retirement accounts, switch up the assets in those accounts for government debt. The government takes the stocks, the government takes the assets, and that's what they use to pay off the government debt. So that is something that can happen. And so for me, I just don't want my assets to be held by these custodians. It just doesn't seem like a good idea. You got 30 years. And it's going to come to a head. This whole debt thing is going to come to a head, definitely in the next 30 years. And some people are saying in the next 5. Okay. I don't know. I don't know. I'm surprised it's even gotten this far, but you do have to kind of consider it's like what is going to happen with all that money that's just sitting there? And you've had Steve Forbes also come out, the guy behind Forbes magazine. He has said they're going to change the rules on the Roth IRAs to where if you have over like $2 trillion in these Roth IRAs, not trillion, if you have over like $2 million in a Roth IRA account, they could make it so that, you've got to pay some tax on those amounts being taken out. If you don't know what Roth IRA is, it's when you pay the tax up front, you contribute post-tax money into your retirement account, and then the earnings um, effectively grow tax-free. And that's the benefit of it. You can take the money out after like 5 years past 59 and a half, whatever, in order to um, get the benefit. So they're going to change the rules. They're going to change the rules. Okay. And you don't want to get stuck with that penalty. It's not even giving you that great of a return anyway. You don't really get to invest in a lot of stuff that you would otherwise want to invest in getting into these 401ks and IRAs. And by the way, I've been reading up on something called the Great Taking. And I didn't know this until recently, but over the last 15, 20 years, what they did was they changed the rules of these retirement accounts, as far as I've read, to make it so that you are a beneficial owner instead of an actual owner of the assets in these retirement accounts. Kind of interesting, right? And you know that because you can get the dividends on your stocks that you own in your retirement account, but you don't get to vote on any of the matters concerning these companies that you're invested in through your 401k. And essentially what I've heard is the voting rights go to the custodians of your assets, and you being a beneficial owner instead of an actual owner just get the dividends and get the capital gains when you sell your stock, but you don't get the voting rights. You give that up when you set up these accounts. Pretty interesting, right? And that's how BlackRock and Fidelity and all these big institutions get all this power over the US economy. They're able to just kind of consolidate power this way. And from what I've also heard, you become a kind of unsecured creditor similar to a kind of person who makes a deposit at a bank. If you make a deposit at a bank, it's not like they're holding that money for you. It's actually that technically you're using the bank as a lender of your money in order to receive a return. And so if the bank goes down, your money is lost, you're an unsecured creditor. See you later. I mean, yeah, there's FDIC insurance and all that stuff, but the FDIC is like 1% funded. It's a total crapshoot, and you probably won't see your money for years. And by the time you see it, it'll be hyperinflated, right? Essentially, you're an unsecured credit of these banks, and apparently it's the same thing now for these 401ks that are held by these custodians. If the custodians go down, then they pay their secured creditors your assets. Pretty interesting, right? So if that's incorrect, give me some sources, but that's what I've read. And so that doesn't sound good either. And so it just increasingly seems like a bad idea to have these retirement accounts. It seems like that much more of a risky endeavor. And again, foreign real estate is a pretty good asset to hold. You actually, as far as I understand, don't need to report the fact that you have foreign real estate in the same sense that you report foreign financial accounts on an FBAR form, unless you start producing income from those foreign real estate items, in which case you need to report that on your U.S. tax return if you are a U.S. resident. Um, but otherwise, it's basically an offshore asset that is geographically diversified. And same thing with holding gold and silver in another country like Singapore or Switzerland or Austria or one of these countries, where they, um, you may have to file an FBAR depending on the circumstances. You need to look into that. But um, that just seems more safe to me. I mean, even if you have to file an FBAR, at least it's not going to be subject to U.S. conscription measures. Okay. And these countries like Singapore are more financially established and safe than the United States. One thing that was also interesting in that book that I was reading by Nomad Capitalist is the fact that the U.S. banks are actually some of the least secure banks in the world by far. If you want secure banks, you go to Germany, you go to Singapore, Switzerland, of course, Austria. Malaysia, even Georgia. These banks are apparently more safe than the banks here in the United States. And another way to diversify is to simply just open up accounts over in these countries and then get exposure to different currencies. And then you get exposure to different markets because you have those different currencies. You want to talk to your tax guy about that, though. That can get complicated quickly because international reporting stuff, I've been doing deep dives on international tax law for like the last 2 months, and it's pretty complicated stuff. So definitely get a guy for that. But it just seems like a better idea than getting into these retirement accounts um, where your funds could be conscripted, and if you need your money over the next 30 years or so, get a 10% penalty plus tax on whatever you take out. Unless, I mean, there's certain qualifications, like if you're a first time home buyer or you're getting it in order to pay for college or something like that. Hardship exemptions, you may be able to take some out without paying those penalties, but you still pay the tax. So it just doesn't really seem like all that a good idea. Now, let's talk about Bitcoin for a sec, because we are a cryptocurrency channel. Let's put this in the context of crypto. Okay, so the problem, this is why I'd want to have private cryptos instead of Bitcoin or transparent cryptos increasingly. One, because Bitcoin has a scaling problem. Okay, we all kind of understand that. The way that it scales right now is using centralized exchanges, centralized ledgers, which, move the ownership back and forth on a ledger that isn't even the blockchain. It's just like, a superseding ledger that allows for the change of ownership. Because if that change of ownership was actually represented on the blockchain, then, you would create a lot of problems for this 6 transaction per second blockchain. Fees would go nuclear, and people say that's a good thing. Right? That means it's working when fees are $100 per transaction, but that wouldn't be good, right? And that actually incentivizes more third-party custodianship because they would be able to have lower fees for that thing I just mentioned because they would actually just record the ownership change on like a derivative ledger, not actually on the base layer. But having custody for that asset would be expensive, number one. But also, they're setting up a system that makes all of these assets transparent and makes them, in my opinion, easier to confiscate than private cryptocurrencies. Now, still, to confiscate these assets, they're going to have to prove that you have the asset and they're going to have to be able to get it. And the way to do that is to incentivize you to be on these third-party centralized exchanges with your assets. Now, Monero doesn't have that problem because it's been kicked off a lot of these exchanges. It just got kicked off. Kraken recently in the U.S. and it was kicked off Binance earlier this year, and it's been kicked off exchanges all over the world increasingly. So it doesn't have that kind of problem. People just naturally self-custody Monero. But if you are a Bitcoin person or if you are a transparent crypto person, then they're going to incentivize you to put your crypto onto these exchanges and thereby make them easily confiscatable. And they're probably going to be doing this through a reporting requirement regime. One thing that kind of surprises me at the moment is that you don't have to file any kind of FBAR reports or any kind of reports on your self custody crypto. I mean, it really does make crypto way better than like an offshore bank account. Now, offshore bank accounts, they have their own benefits. Um, Namely, you can invest your money that you have in your offshore bank accounts and get, a certain yield, interest income, and also just you have more liquid assets. It's more liquid to have money in an offshore bank account than it is to have Monero, for instance, generally speaking, at least right now. I mean, we're trying to change that. We're trying to build a circular economy, but generally we do need more place where you can spend your Monero and have more liquidity. But otherwise, you can have untraceable money wherever you go in the world in your pocket. I mean, as Obama said, it's like having a Swiss bank account in your pocket. And it's amazing to me that they don't have any kind of reporting requirement for these people. I mean, right now, we really have to appreciate that, because I think that's going to change some point in the future. And if you're not on the grid in the future, whether or not because you haven't um, used an exchange before, or your UTXOs have not been associated with any kind of transaction that's been put on a 1099 DA. We've talked about the 1099 DA form, which is coming in 2026, I believe, where every single transaction that takes place with crypto on these brokerages and centralized exchanges are reported on these 1099 DA forms, and they have the taxpayer IDs, they have the taxpayer names, addresses, the transaction ID of that crypto, which can link the UTXOs to names, and essentially creates a giant grid of KYC, artificial intelligence linked information with the blockchain. And if your UTXOs are not linked up with that database that they have that links identification with property on the blockchain, then they're automatically going to have AML signals, which is a thing right now, that says that this is a high risk person that is trying to get rid of their crypto, or these are high risk coins that maybe we don't want to have onto the exchange. And if you want to have it onto the exchange, you want to get your money out, um, then you have to fill out a whole bunch of forms, right? Now, the thing is, if they do make it that people who own a certain amount of crypto have to report that crypto holding to the IRS, then what that's going to incentivize people to do is just simply hold their money at the exchange, because maybe the deal is the exchange then has to file that report instead of the individual if they self custody. And people will not want to make these mistakes, especially if you're dealing with the Bank Secrecy Act, because the penalties for like violating the Bank Secrecy Act are like, it starts at like 10 grand, right? So people are like going to want to um, have these assets at third party custodians. They're going to further incentivize that. And they're going to, I think Coinbase is working on establishing a marketplace recently where you can spend your crypto at different merchants, and those different merchants are going to want to work with the likes of Coinbase, custodial crypto providers, instead of people with self-custodied assets, because with third-party custodial providers, you'll know that those coins are clean. Whereas with a self-custodied person, you're going to want to do your AML checks on that crypto that's coming in, so that you can more easily have the capacity to exchange those cryptos for cash. Because if it is a risky transaction or a risky person you're dealing with, according to the AML check, and if you look at Trocador, that wallet provider, they actually have those inbuilt into the system, those AML kinds of checks. And so if they determine that you're higher risk for that reason, they may not want to do business with you at all. And then you're locked out of the financial system as much as a Monero person, perhaps even more so. Because with Monero, you could go into gold, you could go into other assets, which then you can go into cash with. Um, and people are going to prefer, if you're using money like this, not on an exchange, to take Monero instead of Bitcoin, because um, it'll be harder to cash out your Bitcoin perhaps than it will be to cash out your Monero, because one-to-one Monero, right? It's fungible. Every Monero is another Monero. And so in that case, it could be more liquid because you don't have to worry about those additional concerns regarding taint, one-to-one. Whereas if you have Bitcoin that you can't put onto an exchange, Monero people aren't going to want that. They're not going to exchange their Monero for Bitcoin, especially because increasingly you're able to interact with certain marketplaces that don't accept Bitcoin, but only accept Monero. And so you can actually have more liquid options with Monero than you could for blacklisted Bitcoin. And if that chasm grows between whitelisted and blacklisted Bitcoin because of an increasingly austere regulatory regime, you're going to want Monero instead of Bitcoin, right? So those are just my thoughts on that, and they're going to try to incentivize people to get onto these third-party exchanges. And if you're on these third-party exchanges, your assets are much more easy to conscript. And it could be that when they roll out the CBDC, that's when they say to these exchanges, hey, you need to give up these assets one-to-one for the CBDC that we have. And then they'll comply. So that's a risk, right? I mean, the government can do anything. They really can, especially if they are $36 trillion in debt and they need the money, and you have an entire populace of people who are dependent on that government cheese continuing to come. Okay, they will justify doing any of these things, and so that's the benefit of living in democracy is these people have a say over what happens with your money, and you're just one vote, right? You're just one vote, and the mob can vote against you to take all your money. And so, if you're locked up on these third party custodians and the mob wants the money, they can get the money. And so, that's something to consider. That is something most certainly to consider. So, these are just some thoughts from a bro who has some concerns about the future and how to protect your assets and some other possibilities of how to hold them yourself. So that's what I've got for you, bros. Let me know what you think. Like and comment on the video. Um, if you want to leave a Monero tip, I do have my XMR chat thing that I keep forgetting to plug in the description. You can kind of send a Monero donation, and then you can like do like a super chat through there. It's kind of cool. Otherwise, I have the addresses for Zano and Monero below. And yeah, see you all in the next vid. God bless. Take care.